Welcome to our special session where I intend to update some of our class notes to cope with the new IFRS number 15. The chapter 9 in our class notes have a few pages that are relevant, and then a certain number of pages are removed and will be replaced with a new supplementary handout I shall give you. So this is the plan. Welcome. So, Chapter 9, Inventory and Construction Contracts. The inventory, of course, is IAS 2, which is simply the fact that inventory or stock should be valued at the lower of cost and net realizable value. And that is what the class notes explain. Really easy material. And that tends to come up as part of a big published accounts question, and of course the inevitable multiple choice for 2 marks. So one of the big challenges, as I have been saying, of this new style of paper is you cannot leave anything out, on the grounds that lots of obscure points are coming up for 2 marks each in this 20 multiple choice section. So one possibility, of course, is the new material for IFRS 15. So that's what construction contracts is, IFRS 15. It was IAS 11, but now that's gone. And indeed, parts of IAS 18, or all of IAS 18 has gone, replaced by a part of IFRS 15. So that's the story. What else can I say? Let's move on. As you can see, inventories, construction contracts, what's the issue here, etc. So have a read of that. And as you approach the next page, page 164, as I was saying, inventory should be carried at the lower of cost and net realizable value. Net realizable value is something like the selling price minus obviously cost to sell. Really easy. Now, things like the use of first in, first out, last in, first out, all that kind of thing, average cost, that's outside our F7 syllabus, that's left behind in F3. Even though it's quite an awkward little point. So you just follow the instructions of the F7 exam question. Cost, nothing much for me to say. I'm sure you can read that page yourself for homework. Net realizable value, as I said, is very important indeed. Beyond that, there's a question called DAISY, which you can have a look at yourself. That's part of the homework. And here is a very important challenge from a recent exam. Let me read this with you. This is to be found on page 165. Despite the year end being the 31st of March 2014, the inventory of a company called Highwood was not counted until 4 days later. So would you agree it's 4 days too late compared to the year end? Stock should be counted at the year end. So if that's the start of the year and this is the end of the year, because staff are away, not available, maybe doing ACCA exams, study leave or whatever, because staff are away, the stock count couldn't be done at the end of the year. So it's been done 4 days later. Now clearly, when the staff do the count 4 days later, certain things have happened during the 4 days. For example, purchases might have been brought in. So clearly what you've got to do, if you want to value stock as at 4 days earlier, those purchases need to be taken out. Okay? Similarly, during those 4 days, there will be stock, inventory, sold to customers. Those have got to be brought back in. Okay, so what you normally do, purchases being added in, sales being taken out, you've got to do the reverse. So purchases are brought back in, and sales, or shall we say, purchases are taken out, beg your pardon, and sales, of course, are brought back in. So you do the opposite of what you normally do. Don't forget that when you're doing your sales, often sales are done at marked up prices. So you have to get involved in the old PUP, provision for unrealized profit. So the examiner will show you how to deal with the markups and margins. It's very, very easy indeed. Because this has come up from time to time, I've decided to show you there a little question. This is an extract from a big published accounts question called Highwood. And of course, this little exercise on its own could be part of an MCQ, if not the MCQ itself. So please be careful with that. Very, very important. Very, very easy. That's the point. Don't be afraid of it. So where should we go from there? Now this is the important bit. I want you to remove from your class notes pages 166 to 173 and the corresponding answers at the back, of course, and replace it with the 7 new pages, 8 new pages I will be making available to you. So you always print these things, don't do it on a virtual basis. I'd like you to have a physical copy of the class notes. All right, so I'm going to ask you to replace all those pages, and instead of that, I need to give you some new class notes. Now, the idea behind this, what can I say? I'll tell you what I mean by this. One of the main problems with the old IAS 11, which is this, and IAS 18, which is revenue recognition, is that they found it difficult to deal with when revenue had to be recognized. So for example, if I were to sell you a pen, yes, clearly the date I make the sale is at a particular point in time. That's quite easy to handle. But where, for example, I'm supplying you with a 2-year service, then it becomes more difficult to work out how much revenue to take as you go along. Okay, so this is the kind of idea. The problem that the old IAS has had, that the new IFRS 15 has sorted out. So that's extremely important. I'll write some of these things down for you as we go along. Now, I'll also explain what we mean by over a period of time. A little while ago, I was in Malaysia teaching, that beautiful country. Malaysia, I was teaching, partly resting, and we were staying in this hotel in the center of KL, Kuala Lumpur. So we arrived in this hotel and we drove up, and I was struck by the size of it. And just late in the evening, so I didn't notice much else except the hotel. And as we arrived in the hotel, the person behind the counter, the lady behind the counter said, "We're waiting for you, Mr. Braganza. You're on floor, whatever it was, 30 or somewhere around there." And then the strong man turned up, picked up our suitcases, took us to the lift, pressed the lift, and within a second it seemed like we got up to the 30th odd floor, whatever floor it was. And I was struck by how tall that building was. Next morning, I woke up early. I tend to wake up at 5:30, so I get to work by 8 and get sorted before the students arrive. And it seems to work for me. So I woke up early and I said to my wife, "You must go have a look around the town and the city." And as soon as we came out of the hotel, we came across this building, the most beautiful building I'd ever seen in my life. And probably to this day, I would say that. This, of course, is the Petronas Towers. 2 silver columns, towers, going off into the sky. And completely amazing. And I was so struck by the beauty of the building. And I began to think, I wonder if I can use that for you, for example, as a construction contract example, you see. So the idea behind this is you are the builder of this huge, tall building, and I'm your customer, I'm your client. So you're the builder who's constructing this building over maybe 5 years, and I'm your customer giving you a little bit of money as we go along. So that is the plan. You won't believe it, when I came back from Malaysia, the results had just come out, and it was early February or somewhere around that time. The results had just, F7 results had come out, and this chap came into my class during one of my breaks, and he looked very pleased, and he grabbed hold of my hand, and he looked a little bit Malaysian, not that I'm very good at telling these things, and he grabbed hold of my hand and he shook it, and he said, "Thank you, Francis, I passed, I passed, I passed, I passed. F7, I won't have to do it again, I passed, I'm so grateful to you," etc. And he wouldn't let go of my hand. And I said to him, "How much did you get?" 51, he says. And then from his bag, he takes out a little model of that very building I was admiring 2 days earlier. In fact, I have that model for you to look at here. I brought it in. Here we are. This is a little, these are the two. The original is silver, beautiful. This is a brass model. I'm very grateful for it, though. A student gave me this. And as you can see, maybe I'll turn it. There's office towers there, all air-conditioned, glass-fronted. And these are the two big towers going off in the sky, 452 meters high. Don't know if you know what that means, but it feels very long, very tall indeed. And the clouds, you know, about there. And here you have a little additional bit to the contract the builder did, and that's the observation tower. I believe it is somewhere around the 80th floor, if my memory serves me right. So I said, "Oh, thank you very much." And so I can use it. I'm grateful for these things because I can show them to students and get more students through. You won't believe it, 6 months later, in those days we had our exams just twice a year, a lady came into my class, having seen me show her this, and she said, "Francis, you shouldn't be showing them the Petronas towers from Malaysia. We've got a much better tower in our country." And she brought me this beautiful thing called the Burj Khalifa Tower. In fact, it's a bit more pointy than that. And this is a perfect model for me to show you because it seems to be going up in stages. See how much profit to take, how much revenue to take at each stage, you see? That's the bit. And she said, "You must show them this because, you know, it's a much bigger tower than the other one. But here it is anyway." And I said to her, "How much did you get?" She said, 74. So I said, "Okay, I'm going to show students this." But this is the idea. The reason why I'm holding up these models is to give you a feel for the fact that you're the builder and I'm your customer. Never forget that. You're the builder and I'm your customer. Now, the examiner will tell you how to take profit and the steps, the accounting policy. But quite apart from each question's accounting policy, that will be explained in the question, you must know that the new IFRS 15 approaches it in a much more structured fashion. So that's what I'm going to start you up with. So if you write some notes with me, I'll be most grateful. I'll put these models away in case I drop them. Crystal glass, etc. So here we are. So let's please write with me IFRS 15. IFRS 15, which is known as revenue from contracts with customers. Revenue from contracts with customers, that's the new IFRS. And basically it replaces, please write these notes with me, the old IAS 18, which was called revenue, and IAS 11, which was known as construction contracts, and as I was saying earlier, one of the main problems with the old IAS has now been sorted, and it is the difference between the at model and the over model. So one key examinable problem that you might have to write about with old IAS 18 has now been sorted. i.e., what is known as the at a point in time model or over time model. So how can I distinguish those two? If I go into a shop and buy an item, let's say I go into a shop and buy this pen, obviously I go up to the cashier and he or she behind the counter will take my $2, whatever it might be, give me the pen, and at a particular point in time, as soon as she receives the money from me and puts it into the cash register, whatever, she'll click the machine and it'll go ka-chung like that. And at that point in time, the sale has been achieved by her or him selling on behalf of their company. So I'm a customer, you're the seller. The moment I give you the money and you put it into the cash register, that's the end of the matter. That's very easy to handle. The problem obviously is the other one, and that is where you are doing a building perhaps, like that big Petronas tower I showed you, and how long does it take for you to supply it? It may take 5 years to build it. How much profit to take as you go along? It'll be wrong to take all the profit for putting up this structure in the first year, or indeed wait till the 5th year when it's completed and then take all the profit. Obviously that would be a distortion of the truth. It would not be true and fair, or as it's called nowadays, faithful representation. So there has to be some method whereby the IFRS 15 checks to see if there is a contract, what the contract price is, if there are lots of things involved, how to unbundle the various parts of the contract, etc. So this is the area we're entering. Slightly more awkward than the cash register ringing up the sale at a point in time. At a point in time is easy. Over time, over a period of time, that is more difficult. Okay, so that's a fact. All right, more about that in the class notes, as I say. So I'll give you some, some substitute material for those 8 pages from the class notes, so you'll have access to that. But this is what I would like you to write down with me so you get a bit more into it, so it passes through your mind as you understand this new material. Obviously, this being one of the first exams, certainly for the first few exams, it'll be considered new, and it'll be examined very, very slowly, just for a few marks, and gradually they'll build up into a big question. So I'm going to give you the easy bits as well as the more complex bits so that you're prepared. All right, what else can I say? I mentioned the other problem. Can you leave a line and say, also, sometimes there is a bundle of transactions and under the new IFRS 15, we have guidance on how these kinds of contracts must be unbundled. What I mean by that is if you sell me a machine and then you provide servicing as well, the servicing might last 2 years, even though the machine is sold to me immediately. How do you separate those two? So I'll show you a typical exam scenario in the next few minutes. So let's get into the serious part of this now. Leaving a line, let's write under IFRS 15, to recognize revenue, there is a 5-step model. There is a 5-step model. The first thing is the contract must be identified. The contract must be identified. If there's no contract, you see, there's no revenue recognition. So notice the title of this new IFRS. It says there, revenue from contracts with customers. So it obviously covers IAS 11 as well, the old construction contracts. I notice in the new study guide, the ACCA have dropped any references to IAS 11 construction contracts. So revenue from contracts with customers must replace those old questions, those notes that you have. All right, what else can I say? The next one is the obligations. Under the contract, obviously the price, the contract price. Clearly where the price covers more than one service, one contract, one part of the contract, we have to allocate the price to the separate performance obligations. So in practice, certainly in real life accounting, this kind of guidance is far superior than the old system. And of course, there's a little R to finish off. Revenue using at or over models time. This is always going to be the more likely. And as you can see, I've made up a silly little mnemonic there, COPAR, however you want to pronounce it. So there are 5 steps, clearly where you've got these multiple choice questions. You've got to be able to churn those out as a little challenge. If you get prose, discussion type of questions, knowledge is extremely important, especially of the new material. As I say, it'll come in quite easily, at quite an easy level, and gradually they'll move into more serious numbers. But I'm not taking any chances. I'm going to expose you to some numbers as well today. What else can I say? Let's consider each of these points in turn. So if I were to continue with these things. So let's start with contract. So taking this further, the contract itself, if I can put that into a little bit of a box. Don't forget, we, that's you, we are the supplier, and we supply to a customer. So you're the supplier and you supply to a customer. So first, we look at the deal to identify that there are enforceable obligations. Hence the use of the word contracts, obviously a legal term. Then comes the obligations themselves. I first introduced to you the magic mnemonic that I've made up, and now I'm taking you into a little bit more detail. Then I'm going to attack some numbers, one in class, one for homework, all the while supplying detailed answers. Obligations. Notice it's plural, it's not singular. Several obligations. So let's say, then we identify the individual obligations within the contract. What's known as unbundling. Unbundling, a special word, common sense really. Dash, please write more formally in the new IFRS 15. The old IAS was very informal on this. And for example, you sell a machine to your customer with, say, a 2-year service contract. Very, very easy idea. Or, for example, a mobile phone with separate line rental, etc. You can think of many, many examples. Okay, so those are a couple of these things. Let's move on. The third one is price. Notice this is singular. Just the one price. This is singular. So then we identify the individual obligations within the contract. And the price. Is it variable? E.g., 20 million for construction of, say, a big building like I showed you, or a bridge, and 1 million of a performance bonus if completed on time. So obviously that kind of scenario I'll be dealing with a little later. So this is the idea behind it, you see. The price, is it variable? 20 million for construction of a bridge and 1 million performance bonus if completed on time. Clearly, if the bridge isn't completed on time, there'll be huge public inconvenience. So to encourage you to finish on time, there's a 1 million bonus being added on. So that raises the question, what do you take? Do you take 20 or 21? And for that, you've got to make a judgment. The question will tell you that it's likely to be finished on time, in which case you take 21. So let's say if likely to be completed on time, take 21 million. Okay, so the examiner will give you some sort of guidance as to what to do. So that's your third item. The fourth one, of course, opening up each of these, the word allocation, the A of COPAR. So what to say here? Then we, that's you, we allocate the price between the obligations do what's most logical. In the exam, use ratios or percentages, as we'll see in our questions, classwork, homework, etc. So be very clear what to use, how to do it, what to use. And finally, we come to revenue. And then the revenue is recognized at or over time. And so you have the famous COPA. Keep it up your sleeve, don't show it to the examiner. He doesn't like you to reveal mnemonics. He assumes you're so clever you don't need mnemonics. But we use lots. We go for the oral technique. We do CUD for tax, etc. So there we are. Contract, obligations, price, allocation, and revenue. COPA. Do remember that. Just to finish this off, to distinguish between at and over, at revenue recognition is basically the default model. Revenue is recognized at the point when the risks and rewards and control transfers. And if you go for the over, basically revenue is recognized over the period in accordance with completion. Okay? So can I just round it off by just mentioning a couple of points there. So here we come to the famous at a point in time, revenue recognition. And this is the default model, if you're not sure. So we're going to say revenue is recognized at the point that risks and rewards and control of the asset transfers to customer. As I said, that's the default model. How about the over for F7? This is probably the more likely. Over time revenue recognition. So I'd like you to write revenue is recognized over the period in accordance with completion. We take revenue as things are completed, but it is only permissible, as my class notes will say, the new version, the new substitute pages, this is only permissible under 3 circumstances. Bit of knowledge, really. 3 circumstances. You must have simultaneous and receipt simultaneously receives, probably a better way of putting it, and consumes the benefits. A good example would be something like providing secretarial services. As you send someone to do admin secretarial work for me, if I'm your customer, as he or she does the work, as you supply, I consume. Yes, a whole day, a few days, whatever it might be. So as time passes, automatically it is consumed. So that's a good example. E.g., admin secretarial services. The big word is services. The other little letter I'd like to remember is the customer controls the asset. This is obviously going back to a bridge, that kind of thing. And the other little point, there should be no alternative use So if it's a bridge, for example, it should be used as a bridge. I suppose you could use the bridge as a backdrop to doing some filming or whatever it might be, as in a movie, something like that. So all this is in. So just say, see 6th page of the supplementary note. Or thereabouts, I've said 6th. All right, now the other thing to remember, really, really, really important, that I mustn't forget to say, just say, please write, examiner will give you the company's accounting policy. For taking profit. In the exam question. The company's policy. Yes, so sometimes what happens, for example, the examiner will give you enough information to work out the revenue. It'd be very easy to do something like the work certified. In other words, you're building this building, and I send my architect, my surveyor to check the building, and the architect comes back and says, yes, 4 floors are done. Yes, and so that's the work certified. So that becomes the revenue. And then the examiner will give you a way of working out the profit. So if you have revenue and you have the recognized profit, the difference becomes cost of sales. So every question will explain how to do it, so never worry about it. I'll show you a couple, obviously in my tests and so on. I put in a few more for you to have exposure to the various complications. Very, very easy, but you must be positive. It's new. If you know something about the new material, you're way up there amongst the very few who even know the syllabus has changed. And that's the position I want my students to be in. So at this stage, what I'm going to do is take you into the question. So if I show you the new, to replace pages 166 to 177 of the class notes, and this is a new standard that deals with transactions resulting in revenue. It replaces the old IAS 18 and IAS 11 construction contract, the kind of thing that you just wrote down. So I show you what else we have here. What's the issue here? A company cannot, must not, wait till a long-term contract which lasts several years is completed before any profit or loss is taken to the P&L. Obviously that would be a distortion of the truth, would not be faithful representation. So as the contract progresses, some profit must be taken. Principles of recognition, COPAR, as you can see there, COPAR, and 8 and 9 are 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 as I say there, the effect of this approach is that revenue is recognized when control of the goods or services promised in the contract is provided. Okay, so just follow the questions company's policy. All right, very straightforward. Now here comes my first question. It's called Gale. And then the second question talks about building a bridge. So that bricks and mortar, constructing a bridge, that's for homework with my full answer supplied. But let's see if I can put up a little bit of an answer to the first question. So that picture really goes with the second question. Let's have a look at this. It's called Gale. So let's read together and see if we can make some sense of this. Just by the way, don't forget to read the answer to bricks and mortar, and right at the back of the main class notes is a page on agriculture. Okay, so don't forget to read that as well. So even though I'm replacing pages 166, let me just go back and show you what I mean. Even though I'm replacing a few of these pages, if I take you on to about page 174, just make a note from your main class notes, the ones that you have, that on page 174 there is a new IAS. It's been around a couple of years now, called agriculture, and we've twice we've had 2-mark MCQs on it. How you value growing crops and animals, etc. So I put in a page there with some supplementary reading at the back as well. So make sure you do not forget that. Anyway, let me get back to what the session is mainly about. You can easily read that yourself, agriculture, don't ignore it. Let me take you back to where we are. This is, of course, our new IFRS note. Gale, we were saying, sells processing machines to the food industry. Each machine can be bought alone for $270,000, or as a package with a 2-year service agreement included within the price of $300,000. After the 2-year period, annual service agreements may be purchased at a standard cost of $30,000. So really what you are selling is the 270,000 machine and 2 years of 30,000 each, yes, of servicing. But you're doing a special deal and you're allowing me to buy it for just 300,000. But how do you deal with this in your books? How do you split it? How do you allocate it? The price, the contract price, between the different obligations. That's where the COPAR comes in. Okay, halfway through the current year, interesting, typical exam problem. Halfway through the current year, ended December 31st, 2015, Gale sold 40 machines. So if I take 40 and multiply by 300,000, that figure there would be 12 million, I suppose. And then it becomes a question of how to split it in your books. With a service package in a single order to some farm cooperative, Russian farm cooperative. How should the related revenue be recorded in Gale, your financial statements for the year? Round it off to the nearest percentage. That's the challenge. Let's see how we might face a question such as this. So let me go back to where we were doing our writing and see if we can set up another page. As I say, the question will be very clear as to how to deal with it should the examiner go for more long-term construction contracts. So, example 2, called Gale. From the special handout. Perhaps I'll go back to my traditional narrower style. I'm going to ask, please, for a nice long column, say about 20%, I suppose, all the way down the page. Maybe even moving on to the next page, see how much space we need. So, what shall I say? Step 1, this is IFRS 15, using IFRS 15. So the first problem, of course, is the contract with customer. And so we're going to say Gail has a sale and service contract with the customer. Don't forget, it's a mid-year start of the contract. So I suppose you've got to take 6 out of 24 months, some kind of a fraction like that, as we will see. So that's the first step under control. Let me do lines across to show our progression through the famous COPA. Second step, price. Actually, before I go for price, better be careful. We need to keep in view the performance obligations. So, separate performance obligations. And so what can we say about that? There are 2. One, the obligation to deliver 40 machines. And the second one, of course, the obligation to provide servicing. You see? For 24 months, 2 years. Hence the fraction 6 over 24 just now. So don't forget, these are distinct obligations. These are distinct obligations. Just write that a bit more neatly, sorry. I'd underline distinct, since they could each be provided separately, what's known as standalone. All right, so that's good. That's your second of the COPA steps. We now come to the price, and only now, number 3, price. 40 machines multiplied by, we were saying, 300,000 gives us, of course, 12 million. Now that's very straightforward indeed. So the examiner might give you some facts and ask you to demonstrate your knowledge of IFRS 15, the 5 steps approach. Okay? And that's what I'm taking you to. Number 4, of course, is a tricky little item. This is where we must allocate the price to the separate performance obligations. Allocate the price to the separate performance. Now, this is a little bit tricky. I better be careful. Make sure you grasp this first time. The 12 million is allocated to the 2 performance obligations in proportion to the stand-alone selling price. Remember, it was 30,000 per annum. Standalone selling price at the start of the contract. Comma, of each performance obligation. And here you have to do a columnar style of presentation. Let's say you have the obligation, you have the standalone price, then you have the percentage, and then finally allocation of the revenue. Okay, so let's see how we go about doing this. We might have to move on to the next page, of course. First of all, the machine. And the standalone price in thousands is obviously 270. If we leave a couple of lines, 3 or 4 lines, you can come here to the servicing, and that's 2 years multiplied by 30 per annum, and that gives you 60. And the grand total, of course, is 330. Clearly, you've got to work out some kind of percentage. So if I take 270 as a proportion of 330, that is 82%. And then if I pop in my 82% here and multiply by the 12 million, be careful, the answer on the right has got to be 9840,000. All right, and obviously if that's 82% and this is 100%, this figure that's missing must be 18%. And therefore, the figure here, given that this is 12 million, that difference there, 2160, like that. So sounds like this is the tricky bit, isn't it? Careful of that. So you do your 271st, you do your 62nd, you do your 333rd, you then come back and do the 82%, you then hop across and extend it, and whatever's left becomes a 2160. So this is the kind of thing we mean. How do you split it? And so taking it a little bit further, as the question says, we must be able to demonstrate, how do we recognize revenue? So if I can draw a straight line down the page. So I hope that little common sense arithmetic makes a bit of sense to you. And so we come to step 4, which we've just done 4 actually. This is step 5. Recognize revenue. So a couple of points to look out for. When the machines are provided to the customer, Gail, that's you, should recognize the related revenue by, if I can show a debit and a credit, the language of accountancy, you've got to debit your receivable or bank. The question doesn't say whether you've actually received the money or whether you're going to be paid the money. Not so clear, but the question will give you, the exam question will be a bit clearer. If in doubt, just say receivable stroke bank, that's fine. And of course, you credit revenue, and that goes to your profit and loss account. And that's 984000, like that. So that's point 1. Just make sure I draw that line a bit more straight. All right, so that's your point 1. And the other thing to remember, of course, is when you're doing your final accounts, etc., as the servicing is provided to the customer, the related revenue is recognized. The related revenue is recognized. This is likely to be on a monthly time passing. This is where the new IFRS 15 is so strong, much better than the old IAS 18. Time passing basis. And so, therefore, at the year end, 31st December 2015, if you want to finish off some debits and credits with me, begin to debit once more receivable or bank with 2160 times 6 divided by 24, because it's a mid-year sale, you see. And that's the total duration of the agreement. So if I just go back to 6 over 24, taking you back, Somewhere here we wrote 6 over 24, that thing. And somewhere here we brought in this figure of 2160, this one here. It's so easy. And so if I were to multiply 2160 by 6 divided by 24, this will be 540,000. And of course the credit would go to the inevitable revenue, which ends up on the P&L with 540,000. And don't forget, in the exam you will get detailed instructions about how to work out how much profit to take for contracts, etc. So look out for companies' accounting policy, e.g., revenue and recognized profit can be calculated by you with cost of sales being the balancing figure. For example, so if the examiner gives you information the way you can work out the revenue, you can work out the profit, the difference between the two becomes cost of sales, as I said earlier. And if I go back to my little class notes, beyond that, question called Gale, you have a question called bricks and mortar, where you're constructing a bridge. This time we don't have the unbundling problem, so it's a lot easier. On the other hand, what I've done is taken it much further, shown you how to work out the revenue, what happens in the P&L, see that? And then what happens in the SFP. So that's a learning example, so that's an extremely important one that you must do. Now beyond that, for the next few pages, I explain for home study how the various steps work. I've given you a basic understanding of it. And then as time goes on, if you keep working through all of that, you'll see me in there show you the Gale answer, the kind of question we've just been doing. And then beyond that, there is of course the answer to bricks and mortar. So this is essential homework, must do it, okay? So I've imagined that I'm the examiner and I've taken you through its final conclusion. So the first 5 steps, COPAR, no problem. COPAR, COPAR. And then beyond that, I've shown you with terrific detail how you work out the percentages. The 7 million here is given in the question. So if they give you the cost of sales, use it. If they expect you to do cost of sales as a balancing figure, use it, that kind of thing. And then I've simply taken you through step by step by step the revenue, how you work out the revenue, etc., cost of sales and profit, and then what happens with your journal entries, and then finally what happens in your SFP. You see that? And a couple of other bits and pieces. Okay? So look at the question, look at the answer, and then there are, right at the end, some disclosure requirements. Okay, so that's your IFRS 15. In the first few sittings, as I say, it's going to be quite easy. So don't forget, on either side of IFRS 15, you have IAS 2, lower of cost and net realizable value. And then on the other side, you have agriculture, the IAS 41. So do be a little bit careful not to ignore the IS2 and of course agriculture, though the most important thing is the bit in between. Thank you very much. So once we get past all of that, I thought the last few minutes of our time together we ought to devote to reporting financial performance. Okay, reporting financial. Just check out the name, financial. In fact, it says reporting financial performance. What's the name of our exam paper? Financial reporting. So you can imagine this particular topic must be in the examiner's mind every time him and his team sit down to write an exam paper for F7, reporting financial performance. And there's one aspect of this, something called the Statement of Changes in Equity, which comes up in almost every sitting. So even if it's only for a few marks. So plenty of scope there. I'm going to cover the reporting financial performance as just a few minutes of this particular session, and I'll call it part 1 of reporting financial performance. And then I'll do part 2 beyond that when we will consider other areas like assets held for sale. The assets held for sale is what we call IFRS 5. Reporting financial is IAS 1 and 8. The sort of areas that also govern things like the format for published accounts, as well as things like substance over form, etc. Okay, so plenty of IFRSs, IASs, etc. The very good student can remember things like that. This is what I was telling you about just now, you see. Statement of changes in equity. Some people call it the SOCI, like that. Statement of changes in equity. That must have come up something like 14, 15 times since it's been published, so it's easy to examine, and it's something that nearly half the students don't even attempt because they've never heard of it, mainly because they've been exempted from the lower level, where in F3, lower levels, as some of you know, there's plenty of SOCI in there. So when it comes to F7, when people come up to F7, if they've been exempted, they get caught out. So I'm going to concentrate on that over the next 10 minutes or so, so to get a feel for what this is all about. Okay, so plenty there. Exam focus, something about discontinued operations, etc. Plenty there for you to read. If I can take you directly past a few pages into the bottom of page 178, items such as ordinary or equity dividends paid, accumulated profits brought forward, etc. from previous years are no longer shown in the statement of profit or loss, but in a separate, easy-to-follow statement of changes in equity. So that's my opening shot. That's why we need the SOCI. Things like dividend for the year, very interesting for the shareholder. The profits that were not distributed as a dividend, but owned by the shareholders, brought forward from previous years, they are not shown in the P&L anymore. Where are they shown? In the statement of changes in equity. And that's where I would like to spend our precious few minutes. Statement of changes in equity, as it says there, what it is, the changes between two SFP dates describes the increase or decrease in its net assets during the period. Period usually is 12 months. The overall change in equity during a period represents the total amount of income and expenses, including gains and losses, generated by the entity's activities during that period. Also to be shown must be changes resulting from transactions with shareholders, things like shares and ordinary dividends, etc. And there's something else called the SORI, which came up once, and the examiner is greatly criticized for examining it, so don't worry about that. It's like half a SOCI, so don't worry too much. SOCI is the one that's come up 15 times at least. What it must look like, it's always for the year, by the way. And you can see there, if you're a shareholder, you see, what's the idea behind this? If you're a shareholder and you've put money into the company, let's say, imagine you're a shareholder and I'm the company, what would you like to know? That's probably the best thing to ask. And the answer definitely is, what shares have you got invested? Is there any excess money that you've paid called share premium that the company is holding in another account? Revaluation reserves, has the company revalued its land and buildings? Retained earnings, yes, unappropriated, unused profits after tax, all that kind of thing. All of that belongs, it's like shareholders' funds. Okay, and how has the shareholders' funds changed? This is a little bit like shareholders' funds. One could say, what funds have you invested in the company? Okay, so what I'm going to do in the next few precious minutes is a quick little total like that. This is a nasty little point which you mustn't ignore. I've explained on the next page. And as we read the question, in 5 minutes we can get this done. Question called mallet. The following extracted balances there. So the year we're dealing with is 1st October 13 to September 14. The ordinary shares of 20 cents each means there's 250,000 shares. This is the ordinary share capital. Retained earnings at the start of the year. So that's at the start. Redeemable preference shares must be treated like a liability, which means the interim preference dividend must be treated as finance cost. And so these two things don't go into a SOSI. Ordinary dividend paid, etc. Other information, profit for the year before ordinary dividend was 57.2, and the special excess depreciation, which I've explained over here, and you can listen to on the video library recordings. You can see how I explain all that. Very, very easy, but not to be ignored. It's usually 1 mark in the exam, so be careful. I've explained it elsewhere as well. I'm not too worried about that particular figure. I want to do all the rest of it just to show you how it all fits together. So back we go into our little framework, previous page. The opening balance on share capital is 50,000. The share premium in this question is nothing, so I can ignore that. The revaluation is 18.5. The retained earnings is 47.8, and the grand total is 116.3. The revaluation special transfer is where you take something out of here and you push it into here. How and why I explain in the notes. So don't worry about that. Dividends, this is your ordinary dividends. That is said to be 2,500. So I'll take that away from here and put it into here as well. Total. The profit for the year, if you remember, profit after tax, PAT, is 57.2. And so as you add downwards, that's 50. This is 18. This is 103. And this is 171. And as you add across, we find this plus this plus this, etc. comes to that. Okay, so that's your SOSI. As I say, that's come up something like 15 times in the exam. Usually it's 3 or 4 marks. A smaller version of that, of course, could be 2 marks in an MCQ. The more likely to come up in the big published accounts exercises. Be careful. The only thing about the transfer of depreciation, What happens basically is if you revalue an asset upwards, you've got to charge depreciation on the revalued amount. And because of that, your profit has suffered, the 57.2 has suffered extra depreciation because of the revaluation surplus. And so there's a little adjustment made in the SOSI where something is taken away from the revaluation reserve and put into the retained earnings. So technically you can distribute dividends out of that little transfer. That's where it gets a little bit controversial. So what I would like you to do is to read my words, where I've tried very hard from years of watching the examiner examining this, try to explain how the examiner sees it. And even though you won't be asked for an explanation, you will be asked to do it. And if you know why we do things, you will actually do them with more confidence. Thank you very much for your attention. We have done a few things. I ran through the idea behind inventory and construction contracts, particularly construction contracts. We then did 2 exam questions, and one was mainly on the P&L, one was both. And then I put that to one side, and in the last 15 minutes or so, I introduced to you this idea of a SOSI. And that basically is the plan for this special hour we've had together. Thank you for your time.